The shift in the cryptocurrency landscape during 2025 has been nothing short of revolutionary, and nowhere is this more apparent than in the head-to-head competition between Solana and XRP. This comprehensive analysis examines why major institutions, payment platforms, and developers are increasingly choosing Solana over XRP, and what this means for the future of blockchain-based finance. The context: what happened in 2025? 2025 began with enormous expectations for XRP. The SEC had backed away from its appeals. Major institutions like Franklin Templeton launched ETF products, and prices fluctuated between $2 and $3. The crypto community was optimistic, with many investors openly declaring that XRP would reach $10 by year's end. The narrative was compelling. Ripple had partnered with over 300 banks globally. The regulatory path seemed clear, and XRP appeared positioned to revolutionize international payments. However, something shifted fundamentally in October 2025. Western Union, a company with over 100 million customers that has operated for 174 years, made a strategic announcement that would reverberate through the cryptocurrency world. The company declared that it would build its payment infrastructure on Solana, not XRP. This wasn't a minor partnership. It represented a massive vote of confidence in Solana's technology and ecosystem, while simultaneously signaling that despite Ripple's decade-long efforts, XRP had failed to deliver on its core promise of revolutionizing cross-border payments. The numbers tell the story. As of December 2025, XRP trades at $2.01, down 8% year-to-date. Solana, meanwhile, trades between 125 $145, representing a staggering 1,200% gain over the past 2 years. More importantly, the trajectory is continuing in Solana's favor as we head into 2026. This isn't merely about price movement. It reflects a fundamental shift in how the market views these two competing visions for blockchain infrastructure. The technology battle, speed and architecture. At the most basic level, the difference between Solana and XRP comes down to technological architecture and the performance characteristics that result from different design choices. Solana processes approximately 65,000 transactions per second using a revolutionary consensus mechanism called proof of history combined with proof of stake. Proof of history creates a cryptographic timestamp for each transaction, essentially video recording the sequence of events on the blockchain. Proof of stake then validates these timestamps. The result is a network that can process 65,000 transactions per second with finality, meaning transactions are complete and irreversible, achieved in approximately 400 milliseconds. XRP, by contrast, uses a federated consensus model that is simpler in design but more limited in throughput. XRP processes roughly 1,500 transactions per second, with confirmation times of 3 to 5 seconds. To put this in perspective, Visa processes approximately 65,000 transactions per second. Solana matches this throughput. XRP falls dramatically short. This 43x difference in transaction capacity is not merely an academic comparison. It translates directly into user experience and economics. When Western Union's 100 million customers send money across borders, the difference between a 400 millisecond confirmation and a 5-second confirmation matters. At scale, this translates into the difference between transaction fees of 0.5% and fees of 5%. For a company moving billions in daily volume, this difference represents hundreds of millions of dollars in annual savings or costs. From a business perspective, choosing Solana over XRP becomes a straightforward financial decision. Solana's technological advantage comes with trade-offs. The network requires more powerful hardware to operate validator nodes, and historically, this has led to some network stability issues. In 2021, Solana experienced a complete network outage that lasted 17 hours. In 2023, there were additional network defects that caused concerns about reliability. These incidents fueled criticism that Solana prioritized throughput at the expense of reliability. However, the narrative changed significantly during 2024 and into 2025. Jump Crypto, a development firm, introduced FireDancer, a new validator client written in Rust that dramatically improved network efficiency and reliability. Solana has now operated without critical failures for over a year, demonstrating that the earlier issues were engineering problems that could be solved, not fundamental architectural flaws. XRP, meanwhile, has never experienced a complete network failure. The Ripple consensus ledger has operated reliably for over a decade. This is genuinely impressive from a stability perspective. However, there is a crucial caveat. XRP's stability exists partially because the network does very little. A network with minimal activity and limited functionality will naturally be more stable than one processing millions of transactions daily across diverse applications. As the saying goes, you cannot fail if you do not try. The institutional paradox, RippleNet versus real adoption. The most fascinating contradiction in the cryptocurrency market is XRP's position as an institutional favorite without actually being used. Ripple has engineered partnerships with 300+ banks globally through RippleNet, which sounds impressive. The numbers look good on a press release. However, examining actual usage patterns reveals a critical disconnect. Most banks using RippleNet do not actually use the XRP token. Instead, they use RippleNet as a messaging and infrastructure layer for settlement between themselves. Think of it as a specialized Swift competitor. Banks can use Ripple's infrastructure to communicate payment intentions and settle transactions in fiat currencies without ever touching XRP. The token is optional, not integral to the system's operation. This distinction is crucial because it explains a paradoxical data point. As RippleNet partnerships have grown throughout 2025, actual XRP transaction volume on the blockchain has fallen. In September 2025, on-chain XRP activity averaged $23 million per day. By December 2025, this had declined to $12 million per day, representing a 48% drop in just 3 months. Growing partnerships with minimal token usage suggest that banks see Ripple's infrastructure as valuable, but XRP itself as superfluous. The fundamental problem for XRP adoption lies in banking regulatory requirements known as Basel III. Under these international banking standards, XRP is classified as a Type 2 cryptocurrency exposure with a risk weight of 1,550%. This risk weighting means that for every $1 of XRP a bank holds on its balance sheet, it must reserve $12.50 in capital. This makes it economically impossible for traditional banks to hold meaningful quantities of XRP or build their operations around it. A major international bank cannot justify holding an asset that requires them to tie up $12.50 in capital for every dollar of exposure when they could instead hold dollar-backed stablecoins with a 0% risk weight or maintain actual dollars. This regulatory reality was not created by SEC bias or market manipulation. It is a straightforward consequence of treating XRP as a speculative cryptocurrency asset rather than as a currency itself. The Basel III framework was designed to ensure banking stability, and from a regulatory perspective, cryptocurrency is rightfully categorized as highly speculative. So long as XRP remains classified this way, mass adoption by traditional banks is not merely unlikely, it is technically impossible within the existing regulatory framework. The ETF products launched for XRP in November 2025 by firms like Franklin Templeton and Grayscale represent institutional exposure, but this exposure is passive. Investors buy the ETF and the assets are held in cold storage. This does not generate on-chain activity, does not expand the network's utility, and does not validate XRP's use case as a payment infrastructure. It simply provides a convenient vehicle for investors to speculate on XRP's price appreciation without the technical complexity of self-custody. Solana. Real revenue, real users, real adoption. Solana's story is fundamentally different because it is built on actual utilization and generates measurable revenue. PayPal provides the first example. During 2025, PayPal migrated its PYUSD stablecoin from Ethereum to Solana. The reason is economically straightforward. Ethereum transaction fees range from $5 to $10 per transaction during normal network congestion. Solana's fees are effectively negligible at 0.025 per transaction. For PayPal, which processes millions of transactions daily and operationalizes margin on each transaction, moving to Solana translates directly into higher profitability and lower costs for customers. This is not about choosing a more decentralized network or a network with better tokenomics. This is a straightforward business decision based on cost reduction and efficiency improvement. The Western Union announcement was even more significant. Announced in October 2025, Western Union revealed plans to launch USDPT, its own stablecoin, on the Solana blockchain. Western Union has $2 billion in annual revenue and serves 100+ million customers globally. The company plans to launch USDPT in the first half of 2026, making it available to its massive customer base. Ripple had been working with Western Union for years, pitching XRP and RippleNet. Yet when Western Union moved to actually implement blockchain-based payment infrastructure, it chose Solana, not Ripple. This decision reflects a key insight. Western Union needs to reach retail customers, not just banks. Solana's ecosystem, with its focus on accessibility and user-friendly interfaces, serves this need better than XRP's bank-focused architecture. The revenue data underscores this reality. Over the fiscal year from October 2024 through September 2025, Solana generated $2.85 billion in network revenue. This figure encompasses fees from decentralized finance platforms, trading venues, memecoin launches, and other applications built on the network. January 2025, during the peak of the Trump coin mania, when speculative memecoins proliferated on Solana, saw a single month's revenue reach $616 million. Even accounting for this outlier, Solana maintains a monthly revenue average of $250 million across the current period. To contextualize this figure, Ethereum in 2019-2020, during its early DeFi boom, generated approximately $10 million in monthly revenue. Solana, now in its fourth full year of operation, generates 24x that amount monthly. This is not simply because crypto markets have grown. It reflects that Solana has built a more efficient, higher throughput infrastructure that attracts more actual usage. The ecosystem, where developers build. The most telling indicator of a blockchain's long-term prospects is where developers choose to build applications. Developers are pragmatic. They build where there is demand, where the technology facilitates their goals, and where they can generate revenue or reach users. Solana's ecosystem statistics reveal substantial developer engagement and user activity. The network maintains 1.2 to 1.5 million daily active addresses executing transactions at least once daily. For context, Ethereum maintained similar numbers during its explosive growth period of 2019, when the initial DeFi boom was just beginning. Solana is achieving this engagement level today, with far superior transaction throughput. The network's total value locked in decentralized finance protocols exceeds $13 billion and continues growing. Major DEXs like Radium and Orca, aggregators like Photon and Axiom, and other DeFi platforms generate approximately $1.12 billion annually in fees, representing 39% of Solana's total network revenue. Memecoin activity peaked at over $500 million monthly, demonstrating Solana's capacity to attract speculative interest and capital. Real-world asset tokenization projects represent another $500+ million in value on the network. Gaming applications are beginning to gain traction. AI projects exploring decentralized intelligence are launching on Solana's infrastructure. The critical point is that none of this exists on XRP. The XRP ledger is not a general-purpose platform. It is a specialized payment ledger. It does not have smart contracts in the way Ethereum or Solana do. If you are a developer building a decentralized exchange, an NFT marketplace, a gaming platform, or a lending protocol, why would you build on XRP instead of Ethereum, Solana, Avalanche, Polygon, or Arbitrum? The answer is simple: you would not, and developers have not. Ripple has created RLUSD, a dollar-backed stablecoin, and has experimented with the X-chain bridge for cross-chain communication. But these are specialized tools, not a thriving ecosystem of applications. Comparing the GitHub activity between Solana and XRP Ledger is illuminating. Solana receives thousands of code commits weekly from numerous independent developers. XRP Ledger receives hundreds, a vast difference that reflects the actual level of development activity on each platform. Capital flows and investment reality. The cryptocurrency market's most honest signal is capital movement. Money flows toward what investors believe will grow and generate value. Solana's spot ETF products, which launched in October 2025, saw impressive adoption despite the broader market correction. In December alone, Solana ETF products received $674 million in new capital inflows over a single week, even as Bitcoin experienced a 55% correction that year. This accelerating inflow despite market weakness suggests genuine institutional conviction. Investors are not timing the market. They are adding exposure because they believe Solana's long-term trajectory is positive. XRP ETF products, launched in November 2025, saw initial enthusiasm with approximately $200 million in flows. However, momentum has slowed substantially. December saw only $120 million in new ETF inflows, and the trend continues to decline. This pattern suggests that institutional investors approached XRP ETFs with caution, using them as a small portfolio allocation rather than as a core conviction position. The valuation implications are stark. Solana's price movements correlate with its network revenue and usage. As revenue rises, price appreciation follows. XRP's price movements are decoupled from its network utility. XRP has no internal revenue mechanism. The token itself produces no cash flows. Investors are betting on price appreciation, which is pure speculation. There is no underlying cash generation to justify valuation multiples. Addressing the counter-arguments. Several common arguments support XRP's continued viability, and it is worth examining them directly. First, supporters argue that Solana is unstable and unreliable, pointing to its 2021 outage and 2023 issues. This was a legitimate concern in 2023. However, we are now in late 2025, nearly 2 years into Solana's period of stability under the improved Firedancer architecture. The reliability concern has been addressed. More importantly, technical stability is less important than functional utility. A perfectly stable network that nobody uses has no value. Solana has proven it can simultaneously be stable and extensively utilized, handling 1.3 million daily active addresses, $13 billion in TVL, and $200+ million in monthly network revenue without critical failures. Second, supporters emphasize RippleNet's 300 bank partnerships as evidence of institutional adoption. However, partnerships do not equal utilization. Many of these banks use RippleNet as an alternative communication protocol, but continue to settle in traditional currencies without XRP. Having a partnership means Ripple has convinced a bank to try its infrastructure. It does not mean the bank is economically committed to using XRP, or that meaningful on-chain activity results. The 48% decline in XRP transaction volume, despite growing RippleNet partnerships, proves this point definitively. Third, some investors worry they have lost money in XRP and interpret this analysis as suggesting they made a poor investment decision. This is not the argument being made. XRP could potentially appreciate if major regulatory changes occur. For example, if the Clarity Act passes and fundamentally reorders how cryptocurrency is classified in the U.S. financial system. However, such changes are not expected until 2027-2028 at the earliest. On a 12-month time frame through the end of 2026, Solana is more likely to deliver strong performance because it has real, growing utility and revenue. Scenarios for 2026. Multiple scenarios could unfold in 2026, each with different implications for these two networks. The bullish scenario for Solana assumes that Western Union successfully launches USDPT on schedule in the first half of 2026. If Western Union's 100+ million customers can access Solana-based payments easily and reliably, it would represent a watershed moment for mainstream adoption of blockchain technology. In this scenario, Solana could appreciate toward $200 to $300 by year-end 2026, as additional mainstream payment companies migrate to the platform and developers continue building applications that leverage Solana's speed and cost efficiency. The bullish scenario for XRP is substantially less probable. It would require the Clarity Act to pass the U.S. Senate, fundamentally reordering how cryptocurrencies are classified and regulated. It would require Basel III risk weights to change, eliminating the regulatory barrier to bank adoption. And it would require banks to actually begin using XRP at scale, not merely RippleNet. This scenario, if it occurred, could push XRP toward 5 to 10, but the probability is low, and the time frame is 2027-2028, not 2026. The bearish scenario, with roughly 30% probability, involves the broader cryptocurrency market entering a significant correction cycle. In this scenario, both Solana and XRP would decline. However, Solana would decline less severely because it has existing revenue generation and actual users who believe in the platform's utility. XRP would experience a more severe decline because its entire valuation is speculative. When risk appetite diminishes, speculative assets are hit first and hardest. The 5 core reasons Solana is replacing XRP. Speed and efficiency. Solana processes 65,000 transactions per second versus XRP's 1/500. This 43x difference translates directly into user experience, cost structure, and economic viability for payment platforms. Network revenue. Solana generates $285 billion annually from its ecosystem. XRP generates zero. In finance, cash generation is king. Revenue proves utility. Ecosystem diversity. Solana supports DeFi, 40% of revenue, memecoins, 35%, real-world assets, 15%, and gaming, 10%. XRP is monolithic, banking and payments only. Major partnerships, PayPal chose Solana for PYUSD. Western Union chose Solana for USDPT. These are not coincidental. They reflect companies' belief that Solana better serves their needs. Capital and regulatory clarity. Basel III's 1,250% risk weight kills XRP for banks. Solana faces pending regulatory clarity that could result in more favorable treatment, 400-600% estimated risk weight. Capital flows follow regulatory clarity. What this means for investors. For investors considering exposure to cryptocurrency in 2026, the analysis suggests a tiered approach. If you believe in Web3's long-term future and want broad cryptocurrency exposure, a 70% Solana to 30% XRP allocation balances conviction with diversification. If you believe that blockchain's primary value lies in enabling international payments and cross-border transactions, maintain a 50-50 split, accepting that the timeline for XRP's success is longer, 2027-2028, rather than 2026. Short term, through the end of 2026, Solana is likely to remain stronger. Key milestones to monitor include Western Union's successful USDPT launch in H1 2026, any additional major payment platforms announcing Solana integrations, and any major regulatory developments that would clarify the status of XRP and other cryptocurrencies. For XRP holders, do not panic. The token could appreciate significantly if regulatory changes occur or if Ripple successfully demonstrates real bank adoption of XRP itself, not merely RippleNet infrastructure. However, the probability and timeline for such developments suggests treating XRP as a longer-term, more speculative position than Solana for the next 12 months. Conclusion: the future of payments. The cryptocurrency market's evolution always favors technology that solves real problems efficiently. Solana solves the problem of fast, low-cost transactions at scale. Western Union, PayPal, and other real-world companies are choosing Solana because it demonstrably works better for their business purposes. XRP was designed to solve the same problem, but the combination of limited throughput, regulatory obstacles, Basel III, and over-reliance on bank adoption rather than retail accessibility has constrained its viability. Ripple built an impressive infrastructure in RippleNet, but the market is signaling that this is not sufficient to justify XRP's premium valuation relative to Solana's demonstrated utility. As 2026 unfolds, watch for Western Union's USDPT launch as a critical validation moment for Solana. If mainstream payment companies successfully implement blockchain infrastructure on Solana, it will accelerate the cryptocurrency industry's transition from speculation to utility. XRP may appreciate in such an environment due to broader market growth, but Solana will capture more of the value creation. The cryptocurrency market will continue evolving in 2026 and beyond. The outcome will ultimately favor the technology that best serves real users, not the token with the best marketing or the most ambitious promises. By this measure, Solana has already won the competition for payment infrastructure. The market, as reflected in institutional partnerships, capital flows, and developer activity, is confirming this verdict daily.